Thank you for attending today. My name is Jay Cohen, and I'm a licensed insurance agent with Gibbs Insurance and Financial Services located in Ocala, Florida. Today we're talking about covering mortgages and debt. This is one of the most practical reasons people consider life insurance. It connects directly to real household responsibilities. For many families, the biggest concern isn't a complicated financial theory. It is the house payment. It's the credit card balance that got used for repairs, medical bills, or a rough month. It's the car loan that still has payments left. It's a personal loan that helped bridge a gap. People want to know if something happened to them, their family wouldn't be left trying to handle all the pressure at once. And I want to keep this conversation very simple and friendly. We're not going to make life insurance sound more complicated than it needs to be. We're going to talk about the problem in everyday terms. Then walk through how coverage can be designed around a mortgage, credit cards, car loans, personal debt, and the breathing room a family may need after a loss. The goal isn't to scare anyone. The goal is to give you a more clear way to think about the question, if I were not here, what bills would still show up, and what would I want my family to have the option to do? One reason this topic connects with people is that most of us understand debt in a very personal way. We know what it feels like to look at monthly bills and know exactly which ones have to be paid first. We know the difference between a bill that's inconvenient and a bill that could change where the family lives. So as we talk today, I want you to picture real life, not a spreadsheet. Picture the surviving spouse at a kitchen table. Picture an adult child helping a parent sort through papers. Picture a family trying to decide whether to keep the house, keep the car, or keep normal routines in place. That's the practical side of insurance. I also want to make one point early. This isn't about leaving someone rich. For many families, the goal is much more modest, much more meaningful. It's about preventing a hard time from becoming financially chaotic. It's about giving people, the people you love, enough breathing room to think clearly. And if your own situation isn't perfectly organized, that's okay. Most people don't have a neat folder with every balance, every beneficiary, and every policy ready to go. This conversation can be the beginning of getting that organized. Let's start with the basic reality. Debt does not disappear just because life changes. If somebody passes away, the family may be dealing with grief, funeral decisions, paperwork, and a completely different daily routine. But the mortgage company still expects the payment. The credit card statement still arrives. The car payment still has a due date. Utilities, insurance, groceries, and taxes don't pause while the family catches its breath. That's why this topic matters. When people say, I want enough coverage to pay off my house, what they're really saying is, I don't want my family to feel trapped by the house payment. They may want the option to stay in the home. They may want time to decide whether staying makes sense, or they may simply want to avoid being forced into making a fast decision while their emotions are high. The same idea applies to other debts, like your credit cards can be stressful because minimum payment may be manageable today, but the balance can become a burden if income drops. Car loans matter because transportation is often tied to work, school, doctor's appointments, and family routines. Personal loans matter because they can represent real obligations that don't go away quickly. So today we're not judging debt. Most families carry some kind of debt at different points in life. We're simply asking a planning question. If my income stopped, what financial pressure would land on the people I care about? It can also help to separate legal responsibility from practical pressure. Depending on the debt, the state you live in, the account ownership, and the contract language, not every debt works the same way after someone dies. I'm not giving you legal advice here, but those details can matter. From a family planning standpoint, the practical pressure is often very real, even when the legal answer is complicated. If the surviving spouse wants to keep the home, the mortgage must be addressed. If the family needs a vehicle, the car loan matters. If a joint credit card has a balance, the balance can affect the household budget right away. There is also the emotional side to this. When a family is grieving, even normal bills can feel heavier. A payment that was manageable with two incomes can feel scary with one. A credit card balance that was being paid down slowly can suddenly feel like a wall. A car payment that made sense before may become just one more decision on a long list. That's why life insurance isn't about replacing income in theory. It's about protecting the household's rhythm. The bills tell us where that rhythm could get disrupted. So as you listen, think about the bills that would create the most stress for your family. Not every bill needs to be handled the same way, but the high-pressure ones deserve attention. Before we talk about a policy, we need to start with the bills. I like to make this very simple. If something happened to you, what bills would your family need to pay in the first month, the first 6 months, and the first couple of years? The home is usually the first place people look. What's the mortgage balance? What's the monthly payment? Are property taxes and insurance escrowed, or do these bills come separately? If the family wanted to stay in the home, what would it really cost to keep it? Then look at debts, which include credit cards, car loans, personal loans, student loans, medical payment plans, or anything else with a balance. Some debts may be small but annoying. Others may be large enough to shape the family's choices. Then look at the monthly rhythm of life. This is utilities, groceries, childcare, prescriptions, phone bills, internet, insurance premiums, and regular household expenses. These may not sound dramatic, but these bills keep life moving. Finally, think about transition costs like final expenses or travel for family members, time off work, attorney fees, or someone to help with paperwork, maybe help around the house for a while. Families underestimate this category because it isn't one neat bill. If you want a simple exercise after today, take one sheet of paper and divide it into 4 sections. Label them home, debt, monthly bills, and transition costs. Don't worry about making it perfect. Just write down what you know. Under home, write the mortgage balance if you know what it is, the monthly payment, and whether tax and insurances are included. If you rent, write the rent and how many months you'd want your family to have covered while they regroup. Under debt, list balances that would bother you most if someone else had to deal with them, such as credit cards, car loans, personal loans, medical balances, student loans, or anything else that comes with a payment attached. The goal isn't to feel bad about the list. The goal is to see it clearly. Under monthly bills, think about what keeps the house functioning. Things like food, utilities, insurance, transportation, prescriptions, childcare, school costs, and a phone bill. A family can usually adjust some expenses over time, but the first few months after a loss aren't the ideal time to make adjustments all at once. Under transition costs, include things people forget. These can include funeral costs, travel, time away from work, or it can include help with cleaning or childcare, maybe counseling, maybe legal paperwork, maybe repairs before selling a home. Once those 4 sections are on paper, the conversation about coverage becomes more calm. You're no longer asking, how much sounds like enough? You're asking, what would I want this money to do? The mortgage is often the emotional center of the mortgage protection conversation. For many families, the home is the center of everyday life. So the mortgage conversation feels personal. The home is where the family lives and where children are growing up. It's close to school, work, neighbors, doctors, church, or family support. So when people say they want mortgage protection, it's not about the mortgage. It's about making sure your family can stay in the home they love. Now, does every family need to pay off the mortgage completely? No, not always. Sometimes the surviving spouse has enough income to keep making the payments. Sometimes the plan might be to cover the payments for several years without wiping out the loan. Sometimes selling the home may actually be the right decision. But what we want here are options. If life insurance gives the family enough money to pay off the mortgage, or at least reduce the pressure, then the family has room to choose. They can stay or sell later. They could even refinance. They can have the option to decide after the first wave of stress has passed. Without that cushion, the house payment can make decisions for them. That's what we're trying to avoid. There's another reason the mortgage deserves its own conversation. The home often holds the family's routines together. The children have friends nearby. Their surviving spouse knows the neighbors. The family knows the drive to work, school, the doctor's offices, and the grocery stores. Losing a loved one is already a major disruption. Losing the home quickly can make that disruption much harder. That does not mean the family must stay forever. Sometimes a smaller home or moving closer to family could be good for them. But timing matters. There's a big difference between choosing to move after thinking it through than there is feeling forced to move because the payment can't be handled. Life insurance can help create time. Time to decide whether the home still fits. Time to clean out a room at a humane pace. Time to let children finish the school year, or time to talk to a real estate professional without panic, and time to breathe. For some families, the plan may be to pay off the mortgage completely. For others, it might mean providing 2 or 3 years of payments. And for others, it may be to reduce other debts so the mortgage payment becomes manageable. Those are different strategies, and each one can be valid. The point is to decide the strategy before the family is under pressure. If the home is important to your plan, coverage should reflect that. When people ask about how much life insurance they need, I like to bring the question back to the job. What do you want the coverage to do? If the goal is mortgage and debt protection, the first part may be the mortgage balance. Then add other debts that you don't want your family to inherit as pressure. This can be credit cards, car loans, personal loans, and any other obligations that would be hard to manage if the family income changed. Then think about monthly support. Even if the mortgage and debts were handled, the family still needs income for everyday life. A surviving spouse may need time to adjust. Children may need stability. A family may need a few years where the budget isn't stretched to the breaking point. Then include final expenses and transition costs, such as funeral costs, travel, paperwork, and short-term help. These expenses can add up quickly. So, a simple way to think about this is mortgage plus debts plus monthly support plus final expenses. That doesn't produce a perfect number, but it gives us a practical starting point. Let me slow this down with one more example. Suppose the mortgage balance is $300,000. Final expenses, depending on what you want, can be up to $15,000 for a funeral. There's also $18,000 on credit cards, a $22,000 car loan, and the family wants $3,500 per month for 2 years to help replace lost income. 2 years of support at $3,500 per month is $84,000. At $40,000 for final expenses and transition costs, and the conversation is now around $439,000. That doesn't automatically mean the person should buy exactly $439,000. Insurance companies have underwriting rules. Budgets matter, existing coverage matters, your health matters, but the number has a reason behind it. Now compare that with picking $100,000 because it sounds like a lot of money. $100,000 is a lot of money in everyday life. But if there's a large mortgage, other debt, and a need for income support, it may not do what people assume it will do. On the other hand, we don't want to overbuild a plan without considering affordability. A policy that a family can't afford comfortably isn't a good solution. The best coverage amount is the one that balances the real need, the budget, and the purpose of the policy. This is why I like simple math, nothing fancy, just honest math. What's owed, what income would be missing, what costs would appear quickly, what would give the family choices. Term life insurance is often part of mortgage and debt conversation because many of these needs are temporary. For example, a 30-year mortgage has a timeline. Children eventually become adults, car loans, and credit card balances can be paid down. Income usually has working years window. That doesn't mean protection becomes unimportant later, but the size and purpose of the need may change. Term life is designed for a set period, such as 10, 20, or 30 years. It's often used when somebody wants a large amount of coverage for a period of time when the financial responsibility is high. For many families, that lines up naturally with a mortgage, raising children, or protecting income during working years. The appeal is that term coverage can often provide a larger death benefit for a lower starting premium than the permanent coverage. That can be important when the immediate need is a large mortgage or a young family budget. The trade-off is that term coverage usually doesn't build cash value. It doesn't last forever unless it's converted or replaced under the policy rules. When the term ends, coverage may end, become much more expensive, or require new planning. A lot of people also ask whether the term should match the mortgage exactly. Sometimes that makes sense, but not always. A 30-year mortgage might point towards a 30-year term policy, especially for a younger family buying a home. But if the mortgage is already halfway paid down, or the children will be independent soon, a different term may make sense. There's also budget decisions. A 30-year term policy usually costs more than a 20-year policy because the company is promising coverage for a longer period of time. That longer promise can be valuable, but it has to fit the household budget. Health is another reason not to wait too long. Life insurance is usually easier to get when somebody is younger and healthier. If a person waits until there's a diagnosis or a major health change, coverage may become more expensive and harder to qualify for. So even when the need feels far away, it can be smart to review it while options are still open. Some term policies also include conversion options, which may allow part or all of the term coverage to be converted to a permanent coverage later without going through new medical underwriting. Not every policy has the same rules, deadlines, or product options, so it's worth asking about at the beginning. The simplest takeaway in this, term life can be very practical fit for mortgage and debt protection, but the details still matter. Coverage amount, term length, premium, conversion options, and beneficiary setup should all be reviewed together. One helpful idea is layering. Sometimes people assume they need one policy to solve everything. But in real life, different responsibilities have different timelines. A mortgage may have 25 or 30 years left. A car loan may have 4 years left. Children may need support for 10 to 15 years. Final expenses are a lifetime concern. Legacy goals may be different yet again. Layering coverage means we can match coverage to the responsibility. A larger term policy might cover the mortgage and income protection years. A smaller permanent policy might be considered for final expenses or lifetime protection. Or a family might use one term policy now and review permanent options later. This can be useful because it keeps the plan from being all or nothing. The goal isn't to buy the biggest policy possible or the most expensive policy. The goal is to build something that fits the budget and protects the right things. Layering also gives us room for review. As debt decreases, children grow up, income changes, or retirement approaches, the plan can be revisited. Layering can also make the budget conversation easier. Instead of trying to buy one large permanent policy or one policy that does every possible job, we can break the need into pieces. For example, the mortgage layer might be the largest because the mortgage is the largest balance. The income layer might be designed to give the family a few years of support while they adjust. The final expense layer might be the smallest but longer lasting. The longer term layer might be something permanent if that fits the goals and the budget. This approach can be especially helpful when people are in different stages of life. A couple with young children might need a large amount of temporary protection. A couple nearing retirement may care more about smaller mortgage balance, final expenses, and avoiding debt. A single homeowner may want coverage so a sibling, parent, or adult child isn't stuck dealing with a rushed sale. Layering also gives permission to start with the most important need. Sometimes people delay because they think the perfect plan is too expensive. But a practical plan can start with the biggest risk and improve over time. Maybe the first step is covering the mortgage. Maybe the second step is reviewing beneficiaries. Maybe the third step is adding a smaller policy later. Insurance planning doesn't have to be all or nothing. It can be built in layers, reviewed in layers, and adjusted as life changes. Here is a practical point that's easy to overlook. Life insurance usually pays the beneficiary, not the mortgage company or the credit card company. That can be a good thing because it gives the beneficiary flexibility. They can decide whether to pay off the mortgage, make payments for a while, pay off credit cards, keep cash available, or handle other urgent needs. But flexibility also means the beneficiary decisions matter. Who receives the money? Are they the right person to carry out the plan? Are beneficiaries up to date? Has there been a marriage, divorce, birth, death, or family change since a policy was purchased? I have seen people treat beneficiary forms like a one-time task, but they should be reviewed. A policy can be perfectly designed and still create confusion if the beneficiary information is old or unclear. It's also helpful to talk through intentions. You don't have to share every detail with everyone, but the right person should know that coverages exist, where the policy information is, and who to call. If the purpose of the coverage is to protect the home, it helps if the beneficiary understands that. Beneficiary choices are also where communication can prevent confusion. Imagine a parent buys life insurance because they want to protect the house, but the beneficiary has no idea what the intention was. The money may still be useful, but the family may not use it the way the parent expected. That doesn't mean you need to have an uncomfortable family meeting with every detail on the table, but the right person should know the basics. There's a policy. This is where the paperwork is. This is who the agent is. This is the general purpose of the coverage. It's also important to review contingent beneficiaries. A primary beneficiary is the first person or entity in line to receive that benefit. A contingent beneficiary is the backup if the primary beneficiary can't receive it. If that backup is missing or outdated, the claim can become more complicated than it needs to be. Beneficiary forms should also match the rest of the plan. If there's a trust, a divorce agreement, a minor child, a blended family, or a special family situation, it's worth getting proper legal guidance. Life insurance can move quickly to the named beneficiary, which is one reason it's valuable, but it also means that the forms need to be right. The simple action step is to review your beneficiaries once a year and after major life changes. It isn't exciting paperwork, but it's very important paperwork. There are 3 assumptions I'd be careful with. The first is that my employer coverage is enough. Employer life insurance can be a valuable benefit, and I'm glad when people have it, but it may be limited. It may be 1 or 2 times salary. It may end when employment ends. It may not move if you change jobs, retire, or become too sick to work. The second assumption is that mortgage insurance covers everything. People use that phrase in different ways. Some mortgage protection coverage is life insurance. Some is tied closely to the loan. Some pays the lender directly. Some may decline as the mortgage balance declines. The details matter. If the family needs flexibility, a policy that only pays the lender may not solve every problem. The third assumption is that my family can still sell the house. Maybe they can. Maybe selling is the right decision. But selling a house under pressure is different from selling by choice. The market may be slow. Repairs may be needed. Children may be in school. A spouse may not be emotionally ready. There may be costs, taxes, moving expenses, and timing issues. The reason these 3 assumptions are common is that each one contains a little bit of the truth. Employer coverage may help. Mortgage insurance may help. Selling the house may be an option. The problem comes when we assume those things solve more than they really solve. For employer coverage, ask how much it is, whether it's portable, what happens if you leave the job, and whether the benefits are enough after taxes, debt, and lost income are considered. If the employer coverage is 1 times your salary, that may sound helpful, but it may not come close to covering a mortgage and years of household support. For mortgage insurance, ask who gets paid. Does the money go to the family or directly to the lender? Does the benefit remain level or decline as the loan balance decreases? Can your family use the money for other needs, or is it locked into the mortgage? Flexibility can matter. For selling the house, ask, what would that really look like? Would repairs be needed? Would the market be favorable? Would the family have somewhere to go? Would the children have to change schools? Would the surviving spouse be ready to make that decision quickly? These questions aren't meant to scare you. They're clarity questions. The goal isn't to criticize any one option. The goal is to make sure the plan you're counting on would actually work when your family needs it to work. Okay, let me bring this home. Covering mortgage and debt isn't about being dramatic. It's about being kind to the people who would keep going if you were not here. It's about asking what would still need to be paid, what choices my family would need to make, and how can I make that moment a little less financially stressful. A good plan doesn't have to be complicated. Start with the mortgage balance and monthly payment. Add other debts. Think about monthly support, Include final expenses and transition costs. Then look at the coverage you already have and ask whether it matches the job. If you already have life insurance, let's review it. We can review the type of policy, coverage amount, the term, beneficiaries, and whether it still fits your life today. If you don't have coverage, or if your current coverage is no longer enough, we can talk about options that might be term life, permanent life, or a combination. The right answer depends on your goals, budget, health, timeline, and the people you want to protect. My invitation is simple. Schedule an insurance review. Bring what you have. Bring your mortgage balance if you know it. Bring a list of debts if you have one. If you don't have everything organized, that's okay. We can start right there. Again, my name is Jay Cohen, and I'm with Gibbs Insurance and Financial Services. You can reach me at 352-443-5411 or by email at j@gibbsinsuranceocala.com or online at www.gibbsinsuranceocala.com. And please subscribe to my YouTube channel at www.youtube.com/@J the Ocala Insurance Guy. Thank you for being here. I'd be glad to continue the conversation. Before we finish, let me give you a simple way to prepare for a review. You don't need anything perfect. Bring whatever you have. If you have a mortgage statement, bring it. If you have a rough balance from your online account, that's fine too. If you know your monthly payment, but not exactly the balance, start there. If you have credit card balances, car loan information, or personal loans, bring the best numbers you have. If you already have life insurance, bring the policy page or the most recent statement. If it's an employer coverage, bring the benefit summary if you can find it. If you don't know what you have, that's not embarrassing. That's exactly why a review can help. Then think about the people. Who would need the money? Who would make the decisions? Who would help with paperwork? Who would know where to find the policy? These questions are just as practical as the dollar amount. My goal in a review isn't to complicate the conversation. It's to translate the concern into a simple plan. What's the debt? What's the income need? What coverage already exists? What gap remains? What options fit the budget? And remember, a review does not obligate you to buy anything. Sometimes the best result is simply clarity. You know what you have, you know what it's meant to do, and you know what questions still need answers. Thank you again for taking the time to watch this webinar. Protecting a mortgage and household debt may not sound glamorous, but it's one of the most loving and practical planning steps a person can take.